My name is Matt Munson, and welcome to today's episode of Blue Collar Trading. Here we go. I was rummaging through my Webull account today, and I found Francesca's, which I was trading this spring, like day trading, because of the extreme volatility. And then I noticed it's at 51 cents a share. So I thought this would be a good experiment in looking at kind of a turd and seeing if it's a cigar butt or if it's just completely dead. So here we go. RSI, it looked like there might have been some life in here. This is just totally taking a bath. Then we got it, and it's kind of coming up, but then RSI is just like flatline. So let's dig a little bit deeper. Come over to lazyfa.com and look at this. First thing, look at any insider trading, cross reverse partner, selling out, whatever. The only acquisitions are grants or awards to the president and CEO, or to like some of the C-suite people, but they're not paying for any of them. And like at this point, they're just giving them away. But yeah, we can see some of these. Let's see. Red grave. Anyway. Looks pretty brutal here. Not a lot of hope. Doesn't even have a PEG rating. I don't know what that's about. Moving forward into their income statement. So what we start to see is, actually, there's definitely a decline in from 2016 into 2017. But what we see is the earnings per basic share go just like through the floor and completely take a dump. We see a ton of debt being taken on, not a ton, but a lot for the market cap. This company's market cap is, where is it? Oh, here we go, market cap, 1.5 million. So I mean, I don't know. There might be. How many shares are there? Should have looked at this before. Anyway, return on sales. It's looking pretty bad. But what I'm trying to do with this video is see stuff kind of starts to fall off in 2017. There we go. Huh? And then let's go to, this is a 10K from filed, there's a date on this. Oh, February 3rd, 2018. So this should show 2017. And then we go to risk factors. Our long-term growth strategy depends in large upon our ability to successfully open and operate new boutiques each year in a timely and cost-effective manner. Our ability to successfully open and operate new boutiques depends on many factors. Identify desirable locations, negotiate acceptable lease terms, maintain out-of-pocket build-out costs in line with our boutique economic model. Efficiently source and distribute additional merchandise. So like COVID really hit them hard with all of these things because like malls are dying, hire train, growing workforce of boutique managers. We may not be able to efficiently source and distribute the additional merchandise quantities necessary to support our growth. Increase in the cost of raw materials or other outputs. I don't think that changed too much. If we're able to effectively operate, replace, upgrade. But where does it start to come off the rails? So this is 2018. 2017 is when we start to see a decline. And then we come to our 10Q from August 1st, 2020. And we're going to look at risk factors. So, citing Corona, they are using the CARES Act, which I'm not sure how that works with the size of it. But, penned and restate certificate. A letter of agreement between Francesca's Holding Corporation, our chief. Certain target level is specified in the employee agreement. It is during the period. Foregoing summary is called. So, net sales change, 29%. It's not terrible. They shut down 19. Boutiques closed. Huh, interesting. So moving down. And this is the 2020, but this is a 10Q. So let's go back to our FINRA and check out our 10K for 2020. Filed February 2020, so this is more of a 10K for 2019. But executive compensation. Not what I want. So I mean, risk factor, business, distribution, management information systems, compensation. E-commerce, there are omni-channel customer experience. We have made significant investment. I mean, let's just, and then we go into risk factors. If any of the following risks actually occur, our business, COVID-19, March 25th to April. Begin reopening a small number of our boutiques and locations where local shutdowns have been lifted. But I mean, let's recent developments. In our fiscal year 2019, we developed and began execution of a turnaround plan to stabilize and then grow our business. This plan includes strategies aimed at enhancing our financial performance, which has declined primarily as a result of our continued comparable sales decline. See our growth strategy below. Realizing benefits from our turnaround plan in the back year of 2019, mainly due to modifications. So they're just turning it around right before COVID hit. Our operating loss decreased to $24 million in a fiscal year of 2019 as compared to $33 million in a fiscal year of 2018. We expect to continue executing our turnaround plan until our desired results are achieved. So the question, substantially all corporate and boutique employments for the duration base salary reduction for senior leadership, suspension of pay on all accounts payable for those other than necessary to support our e-commerce business, deferring rent of all our boutiques, limiting investment in our e-commerce to necessary website and supporting functions, and suspension of all capital expenditures. This doesn't seem like good, especially considering fast fashion, although all fast fashion is in a rough place right now. Amended asset-based revolving credit facility with JP Morgan in 2020. We also filed an income tax refund. And the provision of the Corona CARES. I don't know. Compelling value. It's going to be hard to compete with Amazon in that regard, especially because their brand uses several different vendors, so there isn't like anything that's really defined. Differentiated shopping experience, flexible boutique format, and rigorous real estate selection process. Solid and scalable infrastructure. Goes into the sourcing strategy where it talks about 400 vendors. Here are all of them. There's 2 in Montana, but mall and non-mall, gross square footage. Staying really, they're growing a little bit. Man, this one's a head scratcher, but I think it's gonna be a no. Anyway, let's go back to the financials here. Key ratios is really nice on the FINRA website. Cash flow ratios, financial health, operating cash flow year over year of 70, 61, 65, 14. Man, financial health. And then I've got Lowe's pulled up, so let's compare their financial health. Total current assets, and this is percent. Total current assets 50, but they had a great year this year. Man, it's not totally dead. This, I don't know. This is like actually pretty interesting. Total asset percent. Long-term debt, 6.53. Total liabilities, 95%. So again, let's just compare that. I mean, it's not that far off. I don't know. What I need to do is keep digging. But it'll be interesting to see like a 10Q from coming up. So I might keep this one on the watch list and then also see if it keeps turning around, because if someone knows something that I don't. But at this point, there's no insider trading. There's no hedge funds that believe in it. I can't pull it up on Whale Wisdom, so I can't see the call to put ratio, which is a big thing for me. But I mean, it's just brutal. Anyway, thanks for watching this. I'm trying to just record these for my sake, but I mean, if you like watching them too, that's great. Have a good night.